Hello, everyone. Thank you for the opportunity to speak at this very important event. My name is Andrea Serra, and I'm the Chief Market Development Officer at the International Foundation for Valuing Impacts, or IFBI. And today I will be talking about impact accounting and the important role that impact accounting has to play in terms of fundamentally changing the way in which our current economic system creates and measures value. So, a little bit about IFBI. We are a non-for-profit organization that grew out of the Impact Weighted Accounts project at Harvard Business School. In 2022, we were launched as an independent organization with the goal of taking the work of the Impact Weighted Accounts project, the framework, and the data sets to bring them to greater implementation and to scale. Our mission is to build a global impact economy which can address the enormous social and environmental challenges that we face today by integrating impact valuation into financial analysis, into capital allocation, and into decision making. The way that we are advancing impact valuation right now is through the development of monetary impact accounting and standardized impact calculations, through the development of practical guidance and tools to drive adoption and scale of impact valuation, and lastly, by advocating for the global adoption of monetary impact accounting into regulation and by standard setters. Our theory of change basically rests on four key principles. So, number one, the fact that we think impact can be measured and compared across companies through standardized calculations. Number two, we believe that public reporting of impact is absolutely necessary for the type of economic paradigm shift that we need. Number three, that monetary impact accounting is both cost effective and decision useful. And number four, in an ideal world, we think that all investing should be impact investing, and that companies should really be aiming to maximize stakeholder value as opposed to just focusing on profit. The work of IFBI rests on a very clear mandate. In its December 2021 report titled Time to Deliver, the G7 Impact Task Force stated that we should be working towards a world in which decisions are thoroughly informed not only by risk and return like they are currently, but also by impact. The task force states an urgent call for mandatory accounting of impact as a destination and for a deeper understanding of how impact and value and profit are related. So why do we need impact accounting? I think the answer is fairly straightforward. I think we need impact accounting because it is essential for the development of capital markets that are driven by sustainability considerations. Much like the development of the financial accounting infrastructure that we use today globally has been a necessary condition for the development of today's large-scale capital markets. I think overall, impact accounting solves three main challenges of the current ESG measurement landscape. First and foremost, instead of just capturing only company inputs and activities, impact accounting can actually capture and translate all types of social and environmental impacts into comparable units that business managers and investors can intuitively understand in the language of currency. Secondly, it helps us to meaningfully aggregate and compare ESG impacts using common currency in order to be decision useful. And lastly, in an ideal world, we hope that we are able to rely on publicly available methodologies. A lot of this is still under development, but this is the goal, that this relies on publicly available methodologies as well as publicly available data for increased transparency and replicability. The Impact Weighted Accounts initiative at Harvard Business School was able to test and to pilot impact accounting with a variety of companies as well as with investors. So how did we do this? Essentially, we started off with materiality assessment and an identification of potential impacts that are caused or contributed to by the business. The way that we define impact is as a change in the well-being of a stakeholder of a company as a result of the operations or decisions of that company. It can result in the change of the well-being of a stakeholder. It can either increase or decrease the types of capital or stocks of value. And lastly, it can occur at various points in the value chain of the economy. So we start by taking a holistic look across all affected stakeholders, whether it's a customer, an employee of the company, upstream workers, local communities, and everything in between. And we assess how each group is impacted by the company's activities at each stage of the value chain. In addition, we look at all possible types of capital, as shown on the bottom right of this image. including financial to natural to human and social capital. The second step in the process is to develop an impact pathway for each of the impacts identified in the previous step. So we define an impact pathway as the sequence of events that link an entity's actions with its effects on people and on the environment. So this diagram at the top illustrates what an impact pathway looks like. Starting from the left-hand side, you start with impact drivers, which are essentially the inputs and outputs of a company. An input represents the resources that the company draws upon for its activities, and an output is basically the direct result of a company's activities, including the products and services that it has, as well as any resulting byproducts or production waste. You then take the outcome of those inputs and the outputs. The outcome is defined as basically the resulting level of well-being experienced either by a particular stakeholder or the resulting condition on the environment as a result of that output. You then take that outcome, and you compare it to the reference scenario. The reference scenario or counterfactual outcome is essentially the assumption of what would have happened in the absence of the entity's actions. You take the difference between the two, and then you multiply that by a robust valuation coefficient or valuation factor, as it's commonly known, and then you end up getting that monetary value of that impact in dollar terms or in any other currency. So to illustrate what this looks like for 3 examples, we can take a well-defined metric. So in the case of tons of CO2 or average wages paid, or even the sugar content within a consumer packaged goods portfolio. For each of these metrics, you can then extrapolate the impact on varying stakeholders and determine in monetary terms, for example, in the case of CO2, what the expected incremental damage to human and ecosystem health from every additional ton of carbon dioxide would be. Or in the case of sugar, for example, you could assess in monetary terms what the incidence of disease caused by excess of sugar intake, for example, would be. So this diagram is a little bit of more of a detailed illustration of what I was talking about in the previous slide, where we show how we have used impact accounting for the valuation of corporate environmental impacts. In this case, specifically, GHG emissions and water consumption is what is illustrated here. So for the first 2 columns, the inputs and outputs, we rely on data that is reported directly by companies or by data provided by providers like Bloomberg, Refinitiv, CDP, and many others. And then also for the third column, which is the monetary valuation factors, we are also relying on existing coefficients that have been developed by research institutions and other standard setters. So really the role that IFBI and our partners in our ecosystem and impact accounting have to play is more on the right-hand side of this diagram. For the rest, we are absolutely aligning and building off of existing disclosure frameworks and standards that have already been set, and are simply adding that layer on top on how really do we drive further harmonization and standardization of how the valuation and the monetary the translation into monetary terms is done. So really our role again is kind of on the right hand side of this diagram, and we are of course part of a very large ecosystem of players here. So in terms of what this might look like at the end, so this slide showcases a prototype of a monetary impact account statement. Just disclaimer, this is completely illustrative at this point. Specific terminology, specific concepts and ideas and templates around this are still under development. So again, this is just for illustrative purposes. But essentially, what we envision as the end goal of this process, in addition to this information obviously influencing and being embedded into decision making, is to be able to see some sort of integrated profit and loss statement where you can measure and compare impacts across stakeholders in monetary terms and make these impacts comparable and interoperable with financial information. Conceptually, I think the idea is that we would be able to internalize all costs that are currently seen as externalities of a company and to adjust the profits of a company for the positive and the negative impacts that it has on society and its stakeholders. So taking this approach to corporate valuation really results, I think, in a share price for companies that reflects the total value created for society as opposed to just the value created for investors, for lenders, or for creditors. So, as I was mentioning earlier, the Impact Weighted Accounts Initiative at Harvard really did a lot of extensive piloting and testing with a number of companies and investors. And in this slide, I'm just showing a few examples of how we have seen this play out in real life. So, in the case of investors, for example, we worked with an Australian pension fund to examine what the monetized environmental and employment impact of its most sustainable fund was, and used it as a tool for capital allocation and for advocacy. In terms of companies, a couple of examples here. There's dozens of others, but these are two that we wanted to highlight. So Eisai, a Tokyo-based pharmaceutical company, actually adopted the employment impact weighted accounting as a tool to analyze and communicate performance. Acciona, a Spanish multinational conglomerate, also used impact weighted accounting for all new capex and project decisions. And then lastly, more from the public sector perspective, the Fresno, California Economic Development Corporation is using impact weighted accounts as a fundamental component in their scorecard initiative in order to improve and inform economic decision making and allocation of capital. In addition to this, the Impact Weighted Accounts Project in 2020 published a study where we applied our environmental impact methodology to calculate the total environmental impact of over 2,500 companies across a wide range of industries with data going back to 2010. And I think one of the most interesting findings of this study was that out of over 2,500 companies, a total of 860 created more environmental damage than operating profit. And on top of that, out of these 2,500 companies, a total of 1,445 companies delivered environmental damage that was equivalent to a quarter or more of their profit. Again, the application of these methodologies so far has illustrated a lot of really interesting insights, and we've been able to prove that impact accounting is both feasible and valuable for a range of stakeholders. To conclude my presentation, I just wanted first and foremost to thank you all for the opportunity to present at this very important forum. We launched last year, so we have been focused this past year on growing the organization and really laying a strong foundation and strategy for our research and our market uptake work. We have an extremely ambitious research agenda ahead of us and have also established key partnerships with organizations like the Value Balancing Alliance and others to further drive harmonization of impact accounting methodologies and also help drive further adoption and scalability of impact valuation through more pilots and through tools and educational resources. So we're excited to continue to share more information as we continue to grow and to expand in this space. So I would encourage you, all of you, if you have any questions on our research, our work, or our future plans, please don't hesitate to get in contact with me. Here's my email on this slide. And also for more updates on our work, we regularly post updates on our LinkedIn page. So I encourage you all to follow us there as well. Thank you all, and I look forward to connecting with some of you hopefully in the near future.